Lovely to have all our existing and learners who are regularly listening into and tuning into Get Set Up's learning sessions. And today is an interesting session. We are having a conversation on the new tax rules 2025 and what older adults must know to save more as well as avoid any pitfalls. So I'll ask people join. I'll quickly go through a bit of an introduction. But most of you all who have been regular at Get Set Up are familiar. But just at the cost of repetition for you all, and all the new ones who have come on board, wonderful to have you all. These are learning sessions that we have. Today's session is in partnership and in sponsorship by Tax Buddy, one of our partners. And one of the few takeaways of today's session are going to be what are the tax updates in the budget 2025. So you'll get insights on the latest tax changes and how they impact senior citizens, all our cohort, including new deductions, exemptions, and any investment benefits. How to maximize your tax savings, to learn about the higher exemption limits, any deductions under the various sections or various subsections as well, and how to minimize tax liability for a secure retirement. Also, we'll be covering smart financial planning, discover government-backed schemes like the STSS, and best strategies to optimize savings while ensuring compliance with the updated tax laws. And we have our experts from Tax Buddy, so it's an expert-led Q&A. And one of the things that we tell you all that please put your questions in the chat. It is being monitored live by a colleague, Sushil, so he'll keep answering all the chats on the chat box. So while Kanchan gives the presentation and guidance. So what are we? Most of you are familiar with Get Set Up. We are on a mission to help those over the age of 55 to learn new skills, connect with others, and unlock new life experiences. Our goal is to reduce isolation, loneliness, and equip our community with tools and knowledge to age independently in place. And our community regularly engages in classes online as well as through offline activities like traveling together over longer as well as day trips. So if you're not yet a Get Set Up member, please download the app and get a lot of the content, which is very, even this session is recorded and will be available on the platform, as well as join us for various activities that you're interested in, including, as I mentioned, travel and connecting with more people. So what is Tax Buddy? Quick background on them and introduction. Tax Buddy is partnering with Get Set Up to be the specialist as it's a both an assisted as well as a DIY, a do-it-yourself platform, which is making tax filing, tax planning, and notice management very seamless while ensuring complete peace of mind. It's got years of experience and expertise and has served more than 2,300 PIN codes in India. It has a very high rating of 4.9 on the App Store, as well as 16,000 plus reviews. TaxBuddy's dedicated team helps individuals, especially seniors, maximize tax benefits provided by the government. They're available as an only channel, both on WhatsApp, web, as well as they have the independent app. So you can access tax expert advice anytime from TaxBuddy. Who have we here with us? Kanchan is a very experienced professional. She's an assistant manager at TaxBuddy, and she looks after direct taxation. She specializes in tax compliance and helps clients navigate the complex tax regulations. Her expertise lies in resolving the tax-related queries and aligning the financial flows with regulatory requirements, as well as she has a strong commitment to excellence and deep understanding of client needs. So we have our expert talking about taxation. We all know that it's one of the truths of life, but at the same time, as we approach our older adults cohort, there's tax efficiency or tax harvesting that all of us can do to improve the value of our tax corpus or any income that we earn in the stage of as a senior citizen. So over to you, Kanchan. You've been an experienced person, so we actually are in your capable hands to teach us what are the various regulations and how to navigate this for all our members. So over to you, Kanchan. Thank you.
Thank you, Ashwini, for the kind introduction, and welcome to all the people who have joined us today in this session. So today's session is basically regarding the basics of income tax. We will understand what all provisions are there. First, we will understand the basics, what is ITR, types of ITR regime, and all the basics. Then we will understand the key benefits that are available for senior citizen, because most of you, as per income tax, the age of senior citizen 60 or above. So most of the provisions are quite similar for non-senior and senior, but there are few benefits which are available only to the senior citizen. So we will be covering all of them. And at the end, we will cover the tax planning part, like how you can save more on your taxes. Because avoiding paying higher taxes is again very important rather than compliance only. So we will understand about tax planning also. In today's budget, we will cover budget. In today's session, we will cover budget updates also, both for 2024 budget and 2025 budget, because 2024 budgets are applicable for this year, for which you will be filing the ITR, and 2025 budget, the latest update, as you all must be aware, is of that 12 lakh related update. So that is applicable in the next financial year. So this is very important to know, because many people ask us this question that currently my income is below 12 lakhs. So do I need to file ITR, or do I need to pay tax? Yes, for the current year, you are required to pay tax, but for the next year, you will get the benefit as per budget 2025. Now, moving ahead, let's start. So first, we will understand what is ITR. So ITR, so the agenda of today's meeting is to increase your tax saving and make your retirement a comfortable retirement. Okay. So now we will start where first we will understand what is ITR. Now, when I talk about ITR, many people again have this misconception that my income is not that much. I am not required to pay any kind of tax. I am not getting any refund of the already deducted tax. So do I need to file ITR? The answer is yes. If your income is more than the basic exemption limit, then it is mandatory for you to file ITR for reporting purpose, because ITR is a kind of declaration where you are reporting all your income details, your tax saving investment details, and your other financial information to the income tax department as a part of compliance. So one more important point here I would like to highlight is Ashwini already told you all that if you have any queries during the session also, please make sure that you are putting that in the chat. My teammate Sushil will answer all the queries during the session, and at the end you can just unmute yourself and ask your query directly. So during the session also, to avoid delays, you can just put your queries in the chat. Okay. So yes, so even if your income is not taxable, but is more than the basic exemption limit, which is generally 2,50,000 for non-senior citizen, and for senior citizen, it's 3 lakh or 5 lakh for super senior citizen. So if it crosses that limit, then it is mandatory for you to file ITR as a part of your compliance. And if you miss to file it, then there are provisions for imprisonment and all also. So that you need to keep in mind that ITR filing is mandatory for compliance part. And also it is required for many other reasons like visa application, loan application, and many other processes. So ITR is one of the document that you can show as an income proof and your address proof also. So it's an important document that you should do and comply with. Now, there are two types of regime under the income tax, and based on your investment level and your income level, you need to decide which regime is beneficial in your case. So first regime is the old tax regime. Old tax regime is a regime where the tax rates as compared to new regime are higher, but you are given the option to invest in a lot of investment options with which you can reduce your taxable income and ultimately save on your taxes. Whereas new tax regime, in comparison to old tax regime, has lower tax rates, but most of the investment options that are eligible under old tax regime are not allowed under the new tax regime. So you cannot further reduce your taxable income. You have to pay taxes based on a specified rate. And but if we compare the rates under the new tax regime are already lower. Now, new tax regime is the default regime. This is very important that new tax regime is the default regime. So if you are not specifically opting out of new regime, your taxes will be deducted and you are required to file ITR under the new tax regime only. So if you want to file, one important point here, please note down that if you want to file your ITR under the old tax regime, make sure that you are filing your ITR within the due date, which is generally 31st July of the assessment year. For example, for financial year 24-25, for which you will be filing ITR after 31st March, you can file ITR under both the regimes till 31st July. And after 31st July, you can file your belated ITR under new tax regime only with late fees as applicable, which is 1,000 if your income is up to 5 lakh rupees and 5,000 if it is more than 5 lakh rupees. So this is one important point, that new regime is default regime. And if you want to go with the old tax regime, make sure you are filing it within the due date itself. Now, as I said that under the new tax regime, most of the benefits which are available under the old tax regime, like HRA benefits, or you can say home loan interest on self-occupied property, or ATC deductions, ATD deductions, these options are not available under the new tax regime. So very few options are there with which you can reduce your taxable income. But new regime is a very simple regime, and government is also promoting new regime, considering the simplicity and transparency under the new tax regime. Now, let's also discuss the rates of taxation. So, under new tax regime, as I mentioned, is a very simple regime. The tax rates are, it does not depend upon the age of the assessee, whether you are senior citizen, non-senior citizen, these rates will be applicable in your case. So, up to 3 lakh rupees, there will be no tax on your income above 3 lakh rupees. No, these rules, Nidhi ji, these rules are for current financial year, for which you will be filing the ITR. For next financial year, the rates have changed. The basic exemption limit 0 to 3 instead is 0 to 4 for next financial year. Basic exemption limit has been increased as per budget 2025, but that provision is applicable after 1st April 2025. For current year, for which you will be filing the ITR currently, these rates will be applicable. So up to 3 lakh, there is no tax. On your income above 3 lakh to 7 lakh, 5% tax rate is applicable. On your income above 7 lakh to 10 lakh, 10% rate is applicable. On income above 10 lakh to 12 lakh, 15% rate is applicable. On your income above 12 lakh to 15 lakh, 20% rate is applicable. And on your income above 15 lakh, 30% rate is applicable. Whereas under the old tax regime, if you are a non-senior citizen, the basic exemption limit is 2,50,000. On your income above 2,50,000 to 5 lakh, 5% tax rate is applicable. On income above 5 lakh to 10 lakh, 20% rate is applicable. And on any income over and above 10 lakh, 30% rate is applicable. Whereas if you are a senior citizen or super senior citizen, the basic exemption limit under the old tax regime is slightly higher as compared to non-senior citizen. So if you're a senior citizen, that is 60 years or above, till 80 years, you will get the basic exemption limit of 3 lakh instead of 2,50,000. And if you are a super senior citizen, that is 80 years or more, then up to 5 lakhs, there will be no tax on your income. So yes, these are the rates based on which your income will be taxed. Now there is another concept of rebate under 87A, which is available both under old regime and new regime. So under old regime, if your income does not cross 5 lakh rupees, you will get the benefit of rebate up to 12,500, and out of your pocket, you are not required to pay any tax. But this rebate is benefit is available only if your income does not cross 5 lakh rupees. If your income crosses even by 10 rupees over and above 5 lakh rupees, you will have to pay taxes. Similarly, under new regime, up to 7 lakh, the rebate benefit is available. So up to 7 lakh, there will be no tax because whatever tax is computed will be adjusted with the rebate. But if income crosses 7 lakh, then you are required to pay taxes. Though there are concept of some marginal relief, but that's very minimal. So you can assume that if your income crosses over and above 7 lakh, you have to pay taxes. Now, how to identify? We have discussed what is old regime, new regime, what are the rates of taxation. Let's also understand how to identify which regime is beneficial for your case. So you need to check with your tax expert, or if you have knowledge of income tax, you need to check yourself that what are your income level and what are your deductions level. So if you have extensive deductions like section 80C, 80D, which we are going to cover further in this session. So if you have extensive tax saving deductions and investments, then old regime might be beneficial in your case. But if you don't have much investments, then new regime is definitely beneficial in your case for past year also and for the upcoming year also. Tax rates, as I mentioned, old regime has higher tax rates, but you can invest to reduce your taxable income. New regime has lower tax rates already, so most of the investment options are not available under new regime. Old regime is beneficial for those having significant investments and tax saving expenses, whereas new regime is beneficial for those who prefer simplicity and are ready to pay a certain tax to the government and don't want much of the compliances. So they can go with the new tax regime, as it is a very simple regime. So the basic factor is your income level and your investments and your type or the level of simplicity you want. So new regime is a very simple regime. If you don't want much of the tax saving investments, you just want to pay some tax and utilize your money the way you want, then new regime is beneficial. Otherwise, old regime can be beneficial in your case. This is just a common factor based on which you can decide, but it differs from person to person. So it's always better and advised to check with your tax expert that which regime is beneficial. Now let's understand budget 2024 impacts. This I have covered in today's session because these updates are applicable in your case for this financial year, that is for which you are filing the ITR after 31st March. So most of the updates are very simple, but there were major updates under capital gain taxation as per budget 2024. Whereas budget 2025 had major focus on the middle class over the slab rate based income. So we will cover both of them. So let's understand first budget 2024 updates. So first was the revised tax slab. Earlier to 2024 budget also, the new tax regime rates were there, but they were revised as per budget 2024, which we have just discussed the rates, because of which people falling under the higher income groups can save up to 17,500 in taxes as compared to last year. So earlier there was different slab rates. Now the slab rates have changed under the new tax regime also. And in the upcoming year also the slab rates have changed. So you can see that the government is also focusing on the new tax regime, and they are trying to make it more efficient and more user friendly, so that most of the people can go with the new tax regime. Okay. Second one is standard deduction. So standard deduction earlier, if you, this is for salaried people. So standard deduction is a deduction which is allowed to every person who is showing their income under the head salaries. So standard deduction is allowed. You are not required to submit any kind of proof for the same. So standard deduction earlier was under the new tax regime also 50,000, but that had been increased to 75,000 as per budget 2024. So last year, for which you had filed ITR, you would have seen that the standard deduction available under the new tax regime was 50,000. But in the current year in which you will be filing ITR, you will get the standard deduction benefit of 75,000 under the new tax regime. Under old tax regime, it is still 50,000 only. Third update is regarding buyback tax. So earlier buyback was exempt in the hands of shareholder, but as per budget 2024, it will be taxable in the hands of shareholder as a deemed dividend, and they're required to pay tax on the same based on the slab in which they are falling. Fourth update is the major update that we will cover at the end. Let's cover other updates. Fifth update is regarding NPS deduction. So this is applicable for those who are working, and the employer's contribution to NPS is there. So under 80 CCD2, the employer's contribution to NPS is eligible as a deduction, both under the old tax regime and under the new tax regime. So under old tax regime, the rate is, the limit is 10% of your basic salary, whereas under the new tax regime, the limit is 14% of your basic salary. So this limit was increased from 10% to 14% under the new tax regime as per budget 2024. STT, if you are investing in futures options, then you must be aware that STT was increased as per budget 2024. So this may possibly impact the returns of the investor, and they are required to check on their investments accordingly and decide on their investments. Last update of budget 2024 is angel tax, so which is a tax applicable on startups. So angel tax was abolished as per budget 2024, which is one of the welcoming change that will potentially increase the investments in the country. So these were major updates. Now let's discuss the most important update, which is capital gain taxation. So if many of you might be investing in shares, mutual funds, etc., so they must be aware of long-term capital gain, short-term capital gain rates. So long-term capital gain under section 112A earlier was taxed at the rate of 10% over and above 1 lakh rupees, but now it will be taxed at the rate of 12.5% over and above 1,25,000 rupees. So the rate change is there for long-term capital gain. Similarly, for short-term capital gain, earlier the rate of taxation was 15% as per 111A, section 111A, but now the rate has been increased to 20%. So this is another update of budget 2024 under the capital gain taxation. Holding period was also simplified as per budget 2024. So now for listed assets like shares, mutual funds, if you hold them for 12 months, then it is a short-term capital asset. If you hold them for more than 12 months, then it is a long-term capital asset, and accordingly, the tax rates will be applicable. For short-term, for other than listed assets like land, building, etc., if you hold them for 24 months, then it is a short-term capital asset. And if you hold them for more than 24 months, then it is a long-term capital asset. So these are the basis based on which your capital gain taxation will be done, and accordingly you are required to pay tax on the same. So I hope budget 2024 updates are clear to everyone. In case you have any query, just put that in the chat. If it is not answered, then we can rediscuss it at the end of the session. Now let's also discuss budget 2025 updates. So these are simple updates. Major updates are in the next slide, but There are some other updates also that might be beneficial in your case. So we have just included in the slide. Now, make sure, please note down that these updates are applicable after 1st April 2025. So these are not applicable in the current financial year for which you will be filing ITR. These will be applicable in the next financial year. First update is income tax is proposed to be simplified. So even after working for so many years, the professionals find it difficult to find a simple provision in Income Tax Act because there are many sections, chapters, and other things. Yes. So there are many sections, chapters, and other things under income tax. So it is very difficult and complex to find any provision. So income tax is proposed to be simplified by reducing the sections, chapters, and making it more transparent and easy to understand. So this is one welcoming change of budget 2025. Second update is regarding TDS rationalization. So TDS is proposed to be rationalized. Thresholds are proposed to be increased. Like for example, section 194I, which is applicable on rental payments. Earlier, it was TDS was required to be deducted if the total rent exceeds 2,40,000, which has been increased to 6 lakh for the year, or you can say 50,000 per month. So if your total rent for the month does not exceed 50,000, then you are not required to pay TDS on the same. So this is something that will bring liquidity in the rental markets, and again is a welcoming update of budget 2025. Third update is regarding LRS, which is applicable in, one second. My screen is visible, right?
Yes, it is, Kanchan.
Okay. So yes, third update is regarding LRS, which is regarding liberalized remittance scheme. So when you are transferring funds to foreign, then yes, this LRS is applicable in your case. Earlier, the limit was up to 7 lakh. There was no TCS deducted. Over and above 7 lakh, TCS was deducted. So this threshold of 7 lakh has been proposed to be increased to 10 lakhs, which will make foreign remittances more easier. And also one important point here is on foreign educations, I mean, for students studying outside India, it's very welcoming change that a TCS on education related remittances has been completely removed. So this is one welcoming change as per budget 2025, which will promote foreign remittances and make it easier to send money outside. Fourth update is regarding higher TDS. There are provisions under income tax that if there is no PAN, then TDS will be deducted at a higher rate, that is 20%. Earlier, it was deducted in case of non-PAN cases and non-filing of ITR cases. But now it is applicable only, higher TDS is applicable only in non-PAN cases. So this is another update of budget 2025. Fifth update is an important update, which is regarding updated return. So updated return is a concept under income tax, according to which, as I told you in the beginning, that the due date of filing ITR is 31st July 2025 for current year. If you miss this date, then you can still file your ITR with late fees up to 31st December 2025. But if you miss that due date also, then you will not be able to file normal ITR. In that case, you can file updated ITR, which is a form of ITR through which you can just do your compliances. If refund is eligible in your case, you will still not get refund as per updated return. So you can just do your compliances and pay taxes to the government. It is just an provision through which you can complete your compliances. So the time limit for completing your compliances has been extended. Earlier, the due dates for filing updated returns were 2 years from the end of the assessment year. For example, for financial year 21-22, you can file your ITR updated return till 31st March 2025. This was the last date. But now, as per the budget 2025, you are given extended 2 days, 2 years. So you can still file the ITR for financial year 21-22 till 31st March 2027. So additional 2 years are given to you to complete your compliances as per budget 2025. So this is another welcoming change, though there will be extra penalties for the upcoming 2 years, which is 60% in the third year and 70% of the additional tax in the fourth year. But yes, you are given extended time for completing your compliances as per budget 2025. Sixth update is regarding self-occupied properties. So earlier there was a provision under income tax that you can choose any of your 2 properties as self-occupied, but there was a condition that the other property should not have been let out due to this restriction that you are not able to let out it due to your job, profession, or business. Now this condition has been removed and you can freely choose any of your two properties as let out property. So just the condition has been removed and law has been made simplified. So any of your two properties can be self-occupied properties without any condition. Seventh update is regarding startups. So startup benefits, whatever are available under income tax, the due date has been extended till 31st March 2030. This will increase the startup culture in India and make businesses easy in India as tax incentives are given related to them. So this is another welcoming change of budget 2025. Now, 8th, 9th, 10th, and 11th update are the major updates of budget 2025 for middle class. So eighth is the personal tax related reforms were majorly focused on the middle class people. You can see the additional rebate benefit is given till 12 lakh. For the current year, the rebate benefit is available till 7 lakh only. But for upcoming year, if your income does not cross 12 lakh rupees under the new tax regime, you are not required to pay any tax. Ninth update was this. And as per 10th update, this is one twist in ninth update is these rebate benefit up to 12 lakh is not available on special rate of income. For example, suppose you have 11 lakh of income, which is taxed based on slab rates, but you have 1 lakh of short-term capital gain. So on 11 lakh, you are not required to pay any tax as per ninth update, but on the 1 lakh amount, you are still required to pay tax, though the total income is below 12 lakh. So special rate of income on which special rates are specified under income tax, you still have to pay tax if your income crosses basic exemption limit, and you have to pay tax on the same, even though that is below 12 lakh limit. So special rate of income, you will not get the benefit of rebate. 11th update is regarding changes in the slab rates. So earlier, the basic exemption limit was 0 to 3 lakh. But in the upcoming year, the basic exemption limit will be 0 to 4 lakh. So extended 1 lakh benefit is given. Majorly 10,000 additional benefit you will get. Sorry. Yes, additional 10,000 tax saving you will get due to this update. So 0 to 4, there will be no tax. On income above 4 lakh to 8 lakh, 5% tax rate will be applicable. On income above 8 lakh to 12 lakh, 10% rate will be applicable. On income above 12 lakh to 15 lakhs, 12 lakh to 16 lakh, 15% rate will be applicable. So these incomes are in the multiplication of 4 lakh and rates are in the multiplication of 5%. So 0 to 4, no tax, 4 to 8, 5% rate, 8 to 12, 10% tax rate is applicable, 12 to 16, 15% rate is applicable, 16 lakh to 20 lakh, 20% tax rate is applicable, 20 to 24, additional rate has been introduced, 25%. Earlier, there was no 25% rate under income tax, but now 20 to 24 lakhs of your income, 25% tax rate is applicable. And on any income over and above 24 lakhs, 30% rate is applicable. So these are the rates based on which your tax will be deducted, computed. I'll try to be a bit slow now. Okay. TDS deduction. So TDS, this update is regarding senior citizens. So on senior citizens income, interest income up to 50 lakh, TDS was not deducted. Or over and above 50 lakh, TDS was required to be deducted. So this threshold is proposed to be increased to 1 lakh rupees. So this will increase in-hand income in the hands of senior citizens. So this one update is regarding senior citizens or regarding the TDS deductions on interest incomes. So these were major updates of budget 2025. The main update is up to 12 lakh. There will be no tax under the new tax regime. Now let's come to the main topic, senior citizen tax benefits. So as we just discussed that up to as per income tax, 60 years till 60 years, you are a non-senior citizen and tax rates are different. If your age is 60 or above till 80 years, tax rates are different. And if your age is 80 or above, then you are a super senior citizen and tax rates are different. That we have already discussed. Why government is giving tax benefits to senior citizens is to ensure their financial security in retirement, to support older citizens with rising cost of living. It is designed to reduce their overall tax burden so that they have more of their income in hand, and to create additional sources of income which are tax exempt, like NPS, etc., which are tax exempt, so that they can invest in them and make their retirement comfortable. So these are the major points because of which the government is providing additional benefits to the senior citizens. Now, key benefits which are available to senior citizens. So first key benefit is increase basic exemption limit, which is 2,50,000 under the old tax regime for non-senior citizen, 3 lakh for senior citizen, and 5 lakh for super senior citizen. So enhanced basic exemption limit is available to senior citizens. Second, section 194P is there, according to which you can skip to file your ITR, but the condition here is you're a resident senior citizen over and above 75 years of age. So if your age is 75 years or above, then you can skip to file ITR if you're a resident senior citizen and you have only interest income in a recognized bank and pension income. Apart from these, if you have income, then it is mandatory for you to report income. Otherwise, you can skip to file ITR. Third benefit which is given to senior citizen is regarding exemption from paying advance tax. Now, advance tax is a concept as per income tax, according to which you have to pay whole of your taxes within the same financial year. For example, for financial year 24-25, you are required to compute your whole of your taxes by 31st March 2025 and pay taxes in installment. There are basically 4 installments of advance tax payment. But senior citizens who don't have a business income are exempt from paying advance tax compliances and they can skip it. So advance tax is again a kind of compliance that is required to be done by everybody. But yes, senior citizens who don't run a business can skip, who don't have an income under the head business and profession can skip to pay advance taxes. Now, various deductions which are available to senior citizens. We are going to discuss deductions in detail also, but let's just cover few special benefits which are available to senior citizens. So Section 80C, special instruments are there where the senior citizens can invest to make the retirement a comfortable retirement, like PPF, which is a very good option to invest in for those who are risk averse, as the return rate is good and they can consider it as an investment option to secure their retirement. NSC the senior citizen savings scheme, combined you can invest up to 30 lakhs in this. So this is another option where you can invest it to secure your retirement. And LIC premium, again, to secure the future of your dependents, is again a very good option where you can go for. So the total benefit of Section 80C is 1,50,000. Apart from these options also, there are other options of 80C, which we are going to discuss further in the session. But these are few investment options that you can consider are good options for senior citizens. 80 TTB, now it is a deduction for interest on saving bank interest plus FD deposits. For non-senior citizens, 80 TTA section is applicable, which is on saving bank interest only. The limit is 10,000 for deduction under that section. But TTB is for senior citizen, that is 60 years or above. On their interest income from saving bank plus FD, they can claim this deduction under the old tax regime up to 50,000 or the amount of interest, whichever is less. So suppose you have saving bank plus FD interest amounting to 45,000. So you are not required to pay any tax on the same under the old tax regime. Under the new tax regime, you will have to pay tax based on the slab in which you are falling. So instead of 10,000, 50,000 benefit is given to the senior citizens on interest income. Additional benefits are senior citizen savings scheme. So it is a government backed option where you can invest in. It is covered under 80C. Combined deduction is 30 lakhs with NSC. NSC has been removed. So total combined, earlier the limit was 15 lakh, but now the limit is 30 lakhs. So combined deduction investment limit is 30 lakhs. And it offers a regular source of income. Interest is paid quarterly and the interest is taxable on SSC. Senior citizen savings scheme. Now let's come to the tax planning part. So we have discussed the basics of income tax. We have discussed budget updates. We have discussed the special benefits which are available to senior citizens. Now we will be covering the tax planning portion, why tax planning is important, how you can plan your taxes. So now tax planning under income tax, there are two concepts. One is tax evasion. The other one is tax planning. So tax evasion is a big no-no because it is wrongly utilizing the income tax provisions or escaping your income to reduce your taxable income and ultimately the taxpayer on. But tax planning is a legal way to reduce your taxable income and save on your taxes. With tax planning, you are checking your total income, investing in the options that can help you save on your taxes and ultimately increasing your in-hand income. So senior citizens generally or often live on a fixed source of income like pension, savings, or retirement funds. So it is important for them to plan their taxes and accordingly make their retirement a comfortable retirement by doing a proper tax planning. With proper tax planning, you can maximize your retirement savings, reduce your taxable income, and ultimately the tax thereon. And this will make your retirement a comfortable retirement as you will have more of your income in your hand. The main motive of tax planning is to preserve your goal, maximize your savings, and ensure that you have a long-term financial stability. So tax planning is something that can increase your in-hand salary, basically for salaried people, and for others, increase your in-hand income. Now, how you can plan your taxes is first take benefit of higher exemption limits. So first is since senior citizens are given higher basic exemption limit, so ensure that your net taxable income is within that basic exemption limit so that you are not required to pay any taxes. So ensure that your net taxable income after including all sources of income is below the basic exemption limit. So you are not required to pay any taxes due to that. Second is make the highest investments options. If old regime is beneficial in your case, you can take maximum benefit of Section 80C, which is 1,50,000 by investing in PPF if you're a risk averse person and wants good return and a government backed secured return. ELSS, which is one of the good option of 80C, considering the rate of return and lock-in period, and other options like senior citizen savings scheme, etc., to make your total income within the limit and save more on your taxes. So you can fully utilize the limits by contributing into retirement savings or other eligible schemes. Senior citizen savings scheme, we have already discussed that it is a government back option. So earlier the limit was 15 lakh, but combined to NSC as NSC has been removed. So you can invest up to 30 lakhs in the same. And this will also help you. This will provide you dual benefit. One, it is secure, providing you a regular source of income in the form of interest and also helping you in tax saving under Section 80C. So you can invest in senior citizen savings scheme and make a regular source of income for yourself. 80D additional benefits are given. So 80D, these all sections we are going to cover at the end also. But yes, special benefits are given to senior citizens in these sections by additional deductions. So 80D is something, a deduction which is available under the old tax regime on health insurance premium. So health insurance premium for non-senior citizen, the limit is 25,000. But for senior citizen, the limit is 50,000. Additionally, since many of the companies don't allow health insurance to senior citizens, so if you are paying for your medical expenses, then that is also eligible as a deduction under Section 80D up to 50,000 rupees. So total benefit under 80D you can claim is 75,000. That is 50,000 for self and 25,000 for your children if you are paying for them. 25,000 medical insurance premium. So medical expenses related deduction is available only to senior citizens. It is not available to non-senior citizens. So additional benefits are given and you can ensure that you are taking full advantage of that by investing in health insurances and making your health a secured one. Now, what are the tax planning tips for senior citizens? The first one is plan your tax-free incomes. There are various sources of income or some investment options on which the return is tax exempt, like Provident Fund, Sukanya Samriddhi Yojana, the interest is exempt. Many options like PPF, etc., the interest is exempt. So you can consider to invest in such tax income sources which are tax-free, like Provident Fund, Sukanya Samriddhi Yojana, NPS, etc. That will help you earn income also and you are not required to pay any tax on the same. Second tax planning tip is optimize your withdrawal strategies. Check your net taxable income and accordingly plan your withdrawals so that for the year in which you are withdrawing, you are within the tax bracket where you are not required to pay any taxes. So you need to check on your withdrawal strategies also that you don't fall under higher taxable groups because of your withdrawal. So you need to optimize on your withdrawal strategies also. And third important point is consider income splitting if possible. So there are concepts like HUF or you can split your income within your family members also. So if that option is possible with you, you can consider income splitting also to bring your income within the tax brackets and to reduce your taxable income. So for that, you can work with a financial advisor and a tax planner and accordingly save on your taxes and plan your finances. So these are some important tips for senior citizens. Now we will just cover the major deductions that are available under income tax. First is section 80C. So 80C we have already covered that the maximum limit is 1,50,000. There are a lot of options where you can invest in for 80C like ELSS, which is one of the good option to invest in, considering the rate of return, which is 12 to 16%. And the lock-in period is only 3 years, which is least among other options. So you can consider to invest in the same, as it provides you dual benefit. First, it is providing you tax saving options, and secondly, it creates a wealth for you. So accordingly, you can consider to invest in the same. Second in this can be PPF, as PPF is one of the good option, exempt category. So PPF also you can consider, the interest is exempt. Lock-in period is generally 15 years, can be extended by 5 years also. So PPF again is a good option considering the rate of return, and it is a government back option. So you can consider to invest in the same, providing you wealth as well as tax saving. NPS again is a good option where you can invest in. So NPS self contributions are eligible for up to 2 lakh rupees, 1,50,000 under 80C and additional 50,000 under 80CCD 1B. So NPS is one of the option where you can invest in. And Sukanya Samriddhi Yojana, which is a very good option as it creates equal value for your girl child, as well as creates a corpus for her future expenses like education, marriage, etc. that you will have to bear later. So it's a very good option to create a corpus for your girl child's expenses and to promote her education. So you can open this account with any of the recognized bank, and the return rate is also good, and interest is exempt, and the majority is also exempt. So one good option to invest in under section 80C. There are other deductions, expenses that you might be doing which are eligible under 80C, like if you're a salaried person, PF would be deducted, that is eligible as a deduction. Then if you are buying a property on which you are required to pay stamp duty charges, that is eligible under 80C. LIC premium is eligible under 80C. Principal repayment of home loan is eligible under 80C, and tuition fee of the child, the school fee component of tuition fee is eligible under 80C. 5-year tax saver FD, this senior citizen savings scheme or post office savings scheme. These are some of the options through which you can save under section 80C and claim under the old tax regime. 80CCD 1B is regarding NPS self contribution. So up to 50,000 you can invest in 80CCD V self contribution, which is eligible under the old tax regime. 80CCD 2, which is for people who are salary. So if your employer is contributing towards NPS, then that is eligible as a deduction. The limit is 10% of your basic salary under the old tax regime, and under the new tax regime, it is 14% of your basic salary. So accordingly, you can consider, and this is one of the option under because of which you can save taxes under the new tax regime. 80D we have already covered, 25,000 for self and 50,000 for senior citizens is the limit that which is allowed under the old tax regime. 80D is not allowed under the new tax regime. 80DD section is again for medical expenses, but this is a conditional deduction. If you have a person who is disabled and dependent upon you, then you can claim deduction under section 80DD up to 75,000. This is a flat deduction irrespective of the amount of expenditure you are doing towards that disabled person on his treatment, training, rehabilitation, and other expenses. So even if you are spending 10,000 rupees, you will get deduction up to 75,000 rupees if he is 40 to 80% disabled. And if he is severely disabled, then you will get deduction up to 1,25,000 flat. So this is a conditional deduction, but if it is applicable in your case, you can claim it and reduce your taxable income. 80DD is for specified diseases. So specified diseases, these are mentioned under Rule 11DD of the Income Tax Act. Some of them are malignant cancers or chronic renal failure, hematological disorders, AIDS, etc. So these are some of the severe diseases. If you are doing some medical expenses on such specified list diseases, then you can claim a deduction under section 80DDB under the new tax regime and claim the benefit. The total benefit is 40,000 or the amount of expenditure for non-senior citizen, 1 lakh or the amount of expenditure for senior citizen. So enhanced limit is given for senior citizen here. 80 TTA and TTB we have already discussed are regarding interest income. So interest for non-senior citizen on saving bank, they can save up to 10,000 rupees on taxes under 80 TTA as a deduction under the old tax regime. 80 TTB is for senior citizen on their saving bank plus FD interest up to 50,000 deduction is available under section 80 TTB. These deductions are available only under the old tax regime. If you are going with the new tax regime, whatever interest you are earning, you will have to pay tax on the same if it is more than the basic exemption limits. 80E is on education loan. So if you have taken an education loan either for self or your dependent family member, then you can claim deduction under section 80E. Under the old tax regime, there is no maximum cap on the amount of interest. Whatever interest you are paying is allowed to you as a deduction. Up to 8 years, you can claim this deduction. So these are few major deductions. Apart from this, section 80G is there regarding donations, where the limit is 100%, 50%, 25%, depending upon the person to whom you are doing that charity or donation. So if you're, for example, if you're donating to Prime Minister Relief Fund, then 100% benefit is available. If you are paying to ISKCON, etc., then 50% is available. If you are paying to some other charitable institutes, then 25% of your aggregate total income is available. So there are different ways to calculate the deductions, and that we can discuss later. In salary, also various allowances. If you're a salaried person like HRA, LTA, etc., these are some of the allowances through which you can plan your taxes. So there are many other options for tax saving, but yes, these were major ones that we have included in today's session. Now we can have the Q&A, and yes, then
this is quite helpful. Thank you, but there's so much of it to consume and digest, and therefore then take decisions. So we have put all of this, or we will be putting all of this as a recorded content available on the Get Set Up app, so you can download the app and have access to it. Especially the last 2 or 3 slides, which are which contain loads of the summary. And as mentioned by Kanchan between discussions, that each individual his tax planning needs to be or can be different based on A, risk profile, B, your situation or your loan situation or your asset or your income situation. So and of course your age as well, 60 versus 80 being the big 2 numbers. So I think some of it is, or most of it requires personal attention, and that's where our partners like Tax Buddy come in picture, where you can call the experts and get to know. So get in touch with your Get Set Up representative, and we can guide any further questions that you may have beyond today, as well as any queries that need to be solved or answered. Our colleagues from Tax Buddy will be able to help and guide you. So maybe we can jump into some of the questions that some people may have, besides the ones that Sushil has already largely answered on the chat. But feel free to ask your questions or raise your hand, and we'll quickly unmute and take those questions. Kanchan, that's a good format. Let people ask questions.
Yes, fine.
Okay. So is there any?
Yes, we have 2, 3 raised hands. So
yeah,
one by they can ask.
Maybe Kanchan, you can pick it up and start answering from your side.
Vijay Lakshmi ji have raised the hand. Yes, you can ask the query. Ma'am, you need to unmute yourself. You are on mute.
We need to hear you.
Yeah, I'm doing it. Yeah, I've done it. Yeah, thanks a lot, Kanchan. It was a very knowledgeable session. It was all very confusing when you read the budget on the paper, and I'm not any professional or anything. I'm just a homemaker. So there's one confusion which I've always been had. I don't know whom to ask, so you're the right person. So the tax exemption, as you said, is 12 lakh for the salary. Are you able to listen, Kanchan?
Yes, I'm able to hear you.
Yeah.
But you will complete your question and I'll answer that after that.
So 12 lakhs plus 75,000, that is the standard deduction. So that is what is, suppose if my income is falling 12 lakh 75,000, I don't have to pay the tax. Okay. Yes. So that is one thing. And then the slab which is given, like 0 to 4, there is no tax, and 4 to 8, there is 5% and all. So in that, how that 8 to 12 lakh is 10%, like one way it is like it is exempted from tax.
Yes.
And that, what is the difference in this, what you told, and the slab wise? Can you please explain that?
Yes, I got your query. So Vijay Lakshmi ji, what happens? The tax will be computed up to 12 lakh also. If your total income is 12 lakh 75,000, you will get the benefit of 75,000 as standard deduction. And the net taxable income will be 12 lakh, on which tax will be computed based on the slab rates as we discussed, 0 to 4, 0%, then 5%, then 10%, and 10%. Okay. but that tax computed will be adjusted with the rebate. So you will not have to pay any taxes. Tax will be adjusted with the rebate. But suppose
what is the rebate? What is the
yes,
rebate, Kanchan?
rebate is available. Amount I have to calculate, but up to 12 lakh, whatever tax is there. Like for last year, it was up to 7 lakh. So up to 7 lakh, 25,000 tax is there. So 25,000 is the rebate. So you will not have to pay any tax. Similarly, under the old tax regime, up to 5 lakh, the rebate is 12,500. So 12,500 is the tax, and it is adjusted with the rebate. So you are not required to pay any tax. Similarly, in the upcoming year also, up to 12 lakh, tax will be computed, but that will be adjusted with the rebate. So you're not required to pay any tax. But if your income is suppose 13 lakh, so since you're crossing 12 lakh, thus the tax will be computed based on the rates. You will not get the benefit of rebate there. So the tax will be lower as compared to last year because the slabs have changed, but you will have to pay tax. So there will be a huge difference between 12 lakh and 13 lakh.
So I have to pay, but then it will be adjusted or it will be refunded something?
No, it will be adjusted. I mean, refunded if your tax is deducted. Suppose you are a salaried person and you are within 12 lakh bracket. So technically, the employer will not deduct any tax since you are going with the new tax regime. But if it is deducted, then it will be refunded by filing the ITR. Adjusted means adjusted in calculations. But if you're filing the ITR and there is a tax and you are not required to pay any tax as per computation, then it will be refunded.
So isn't it a hassle kind of a thing? Like, I mean, why I need to pay and then it will be adjusted or rebated? I mean, my son explained the same way what you said me, but then the thoughts which is coming is why so much hassle? Like, why you have to pay and then it will be readjusted?
Ma'am, the government tries to collect the tax very first because later आपकी जेब से पैसा देना बहुत difficult होता है. तो government
लेकिन फिर हमारा भी पैसा आना लेट हो जाता है ना. हम फाइल करो और फिर पैसा आना भी लेट हो जाता है.
हाँ, तो गवर्नमेंट चाहती है कि आप पहले पे कर दो और फिर उसके बाद वो आपको वापस कर देंगे. आप फाइल करो, हमें रिपोर्ट करो और वापस ले लो.
But confusing and kind of delaying the matter.
Yes, but मैं जनरली आपको बताऊं तो टैक्स नहीं डिडक्ट होगा अगर आप सैलरीड है तो 12 लाख तक अगर आपकी इनकम है तो एम्प्लॉयर भी टीडीएस नहीं काटेगा.
नहीं करेगा. Okay.
हाँ.
Okay. And what about the business income, madam? Like my husband is a small-time business man. I mean, proprietorship, we can tell. So what about the taxes for that? I mean, the business income?
See, for business, the tax is, yes, the incomes are taxable based on the slab rates, but depends upon the type of assessee. As you said, he's a proprietor. So yes, individual rates will be applicable. But again, there are other options of computation of profit. So he will get benefit of expenses, business expenses, etc. And on net profit, he is required to pay taxes. So computation is different. And
so what is the tax rate for that? The profit, I didn't read anywhere over there. I mean, whatever you have also given. He's above 16.
Tax rates are same, but computation of profit differs. If he's going with the presumptive taxation, then he will have to compute profit based on presumptive taxation. That is, if his turnover is within some limit, so he has to compute profit 8% or 6%, that you might be aware, 4480 ADA, etc.
Okay.
And other option is proper balance sheet P&L, where you have to compute your exact profit, and on that you are required to pay taxes. Okay. So that is different.
In the interest,
thanks a lot. Yeah, thanks a lot, madam.
Yeah, thanks. Kanchan, you can take the next question. I think it's Mini Bogia's hands also. Yeah.
Yes.
Yes, Kanchan, good evening. My question is that, like, I have retired from my job and have been contributing to NPS 50,000 rupees per annum. But last year I had filed my tax under the new tax regime, and that 50,000 didn't carry any meaning. So my question is, should I be continuing with NPS or no, or should I be contributing a small amount? What is your opinion?
Yes, NPS is a good option to invest in, but that depends upon person to person. If your financial goals are matching with your investment, then you can continue. If you have better options for which you can consider a financial planner, that he will advise you better on financial planning. But yes, if your future goals are matching with your investments, then you can continue with NPS. Otherwise, if we check with other options of tax investments, then NPS is a good option to invest in, as you will get a regular source of income later once the due maturity comes. So that's a good option to invest in. But yes, again, that depends upon your future goals, how you want to invest, what wealth you want after a certain period, and accordingly. But yes, in my opinion, NPS is a good option to invest in.
Okay, thank you. Thank you.
Ma'am, can NPS be invested after 60 years?
Yes, I think it can be invested till 70 years of age, retirement or something. Earlier it was 60 years old. Tier 1 category you can invest in.
Thank you.
Self-contribution is eligible only under the old tax regime, and employer's contribution is eligible both under old and new regime.
Can I ask one question? What is the benefit, tax benefit on medical insurance? And that is new one.
Yes, we have covered that under section 80D. So for senior citizens, the benefit up for whatever medical insurance premium you are paying, either for self or your dependent children, up to 50,000 you can claim it, and for dependent children up to 25,000. So total benefit is 75,000 for the premium. And if you're a senior citizen, you don't have a medical insurance policy, you're not paying any premium, but you're paying for your medical expenses. So up to 50,000 for that also you can claim. So 80D is the section that will be applicable under the old tax regime. Under new tax regime, no benefit is.
Yes. Thank you.
Kanchan, you may take maybe one or two more questions. We're just around the closure of time.
Sir, can I ask one question? Myself, Anil John. Yeah,
Sure.
I just wanted to know in 80G, how can I know that whether it falls under 50? Mainly the Prime Minister, Chief Minister funds, they all fall under 100%. But normally the receipt given shows that it is eligible for 80G, but not clear when we file that whether it falls in 50%, 100% or 25%.
So that's the list is mentioned on Income Tax Act. So from there you can check, or your tax expert will update you on under which category you fall.
Okay.
So the list is mentioned in Income Tax.
Okay, thank you.
So I think there are no.
Miniji has another question. Yes, you can ask.
Yes. My question is now on PPF. Like we invest in PPF 1.5 lakhs per annum. Since under the new regime, we do not get any benefit. So it's a good option to be investing in PPF. That is not my question. Should we be investing fresh, or should we take out some money and then reinvest in PPF? Take out money from PPF since it's a very old account and then reinvest it. What is the better option of the two?
Ma'am, PPF, according to me, is a good option, but there are better options also available. Then again, the answer is same. It depends upon your financial and future goals. So better advice will be given by financial expert on that.
Something like this is personal, because just in the sense of that each one's risk appetite as well as what stage, etc. So maybe it's good always to get in touch with a financial planner. He or she can help you out. I think even Kanchan's team at TaxBuddy can help you out. So reach out to your colleagues at Get Set Up, and we can facilitate some of that. A lot of this content across investments, across efficient uses of retirement corpus available on Get Set Up. So maybe it's a good idea to just download the app, and a lot of old content, you can just go through it. Reach out to us and we can direct some of those. Once again, I think this will be very helpful. The recording, of course, will be available. But more importantly, we will have another session soon enough on a lot of this, for a lot of us to have an in-depth discussion as well. So watch out for your various messages that you'll hear from Get Set Up team to plan another session like this, as well as download the app, have a look at the content that was just done on live, as well as some of the old content that's available for your benefit. Kanchan, thank you very much. This has been very informative. But as always, questions will always be there beyond the classes as well as beyond the session. So please do put them across to your team at Get Set Up, and we'll get them answered separately. In the interest of time, we'll end the session over here and take your questions offline later on. Recording is available. Just Abhijit, my colleague, has just put that link across. So download the app and you'll be able to see this recording shortly after this.